Hello everyone, and welcome to the Optimus Futures Introduction to Managed Futures. Today we're going to teach you about portfolio diversification through managed futures. We're going to be covering a lot of information, so before we begin, I recommend that you grab a pen and paper to take down any notes or questions you may have regarding this presentation. Without any further ado, let's get started. It is important that you understand the risks that are involved when investing in managed futures. Please read this CFTC disclosure before you proceed. Here at Optimus Futures, we believe every investor should ask himself, is my portfolio designed with the potential to perform well in any type of market condition? There are only three outcomes that can happen in investing. You can either make money, you can lose money, or you can break even. The same thing is true about the direction in which a market can go. The market can either go up, it can go down, or it can go sideways. Can your portfolio profit if the market goes up, if the market goes down, or even goes sideways? That's the question. The research and facts presented in the following slides support the inclusion of managed futures in an overall investment portfolio. For the suitable investor, managed futures may be a good way to diversify one's portfolio. To illustrate managed futures growth, the assets invested in managed futures from 1980 to the first quarter of 2003 grew to $57.4 billion. However, from the first quarter of 2003 through the second quarter of 2012, the assets invested in managed futures have increased from $57.4 billion to $327 billion. Since 1980 to the second quarter of 2012, managed futures have grown over 760%. According to Barclay Hedge, one of the oldest and most respected providers of alternative investment data, out of the total $1.78 trillion invested in alternative investment strategies, managed futures is now number one, surpassing all other investment strategies based on assets under management. We're going to explore why investors are looking at managed futures as part of their overall portfolio. One possible reason investors are turning to managed futures is because managed futures have the ability to offer the opportunity to potentially profit in any economic environment. Be advised, however, that trading futures and options involves substantial risk of loss and is not suitable for all investors. There are no guarantees of profit, no matter who is managing your money. Managed futures are traded by commodity trading advisors. With a commodity trading advisor, also known as a CTA, the CTA is given the responsibility to make all trading decisions in the account through a limited power of attorney, which may be withdrawn by the investor at any time. With this trading authority, the CTA trades all of their accounts according to a system. Accounts are not typically individually traded with the CTA. All accounts trade according to the same system. The role of a CTA trader is comparable to that of a stock mutual fund manager. Both are licensed and registered professionals who make investments in their chosen markets on their clients' behalf. Managed futures can be used in several account types, including individual, joint, corporate, and partnership accounts. They can also be used in a variety of retirement plans, including IRAs, trusts, and pensions. Let's take a look at a comparison between a mutual fund and a managed futures account. Mutual funds may offer investors diversification, which we believe is very important. But managed futures may also offer diversification. Mutual funds are professionally managed just as managed futures are. As I mentioned before, managed futures are professionally managed by CTAs, or commodity trading advisors. Mutual funds offer regulated investment vehicles just like managed futures. CTAs are required to register with the Commodity Futures Trading Commission. CTAs are also required to be members of the National Futures Association, also known as the NFA. The ability to profit in bull markets is very important. Mutual funds and managed futures both have the ability to profit in bullish markets. Now here's where there is an important difference between managed futures and mutual funds. Mutual funds do not have the ability to potentially profit in bear markets, meaning if the stock market goes down or a stock goes down, the mutual fund cannot profit from it. Unlike mutual funds, managed futures do have the ability to potentially profit in both bull and bear markets. Now, CTAs can also employ strategies involving options on futures contracts that allow for profit potential in sideways or neutral markets as well. So, as I mentioned earlier in this presentation, there are really only three outcomes of a market. The market can either go up, it can go down, or it can trade sideways. We recommend that your portfolio should have the ability to take advantage of all three outcomes. Can your portfolio currently take advantage of up, down, or even sideways markets? As one can see, unlike mutual funds, CTAs have the potential to prosper in rising, falling, or sideways markets. Bear in mind that the substantial risk of loss exists no matter who is managing your money, and that potential exists in futures trading to lose more than your initial investment. A benefit to managed futures is portfolio diversification. Diversification is one potentially beneficial feature of managed futures due to the fact that they have almost zero correlation with stocks. The CME Group, one of the largest futures exchanges in the world, has a publication titled Managed Futures: Portfolio Diversification Opportunities, which states that including up to 40% of total investments in managed futures provides the best risk-adjusted returns and greater independence from general market moves. Please be advised that past performance is not necessarily indicative of future results. There are no guarantees that a client will achieve the same or similar results. Let's take this a step further by comparing a traditional portfolio to one including managed futures. The CME Group's booklet, Managed Futures: Portfolio Diversification Opportunities, compares a portfolio comprised of only stocks with a diversified portfolio of stocks, bonds, and managed futures. In this example, the diversified portfolio reduced the maximum drawdown from negative 63.6% to negative 35.9%, and the return also increased over 3 times from positive 6.51% to positive 19.78%. This is mainly due to the lack of correlation and, in some cases, negative correlation between some of the portfolio components in the diversified portfolio. There is even negative correlation between stocks and managed futures as the two markets move independently from each other. A picture is worth 1,000 words, and I believe this picture shows the potential value of having managed futures added to your traditional portfolio. So far in this presentation, I've put a lot of emphasis on returns. As investors, we all know that that's only one part of the overall solution to a better portfolio. Obviously, we want to try to enhance the returns at all times, but at the same time, we want to concentrate on capital preservation or risk just as much as we want to concentrate on returns. So how do managed futures compare to stocks when it comes to risk? One means of comparing risk is to measure the magnitude of the worst cumulative loss in the value of an investment from a peak in performance to the subsequent low. This worst case peak to valley scenario is called a drawdown in the futures industry. Drawdowns are an inevitable part of any investment. However, because managed futures trading advisors can go long or short and typically adhere to strict stop-loss limits, managed futures may be able to limit their drawdowns more effectively than many other investments. Please be advised, however, that the use of stop-loss or contingent orders may not protect profits and may not limit losses to the amount intended. Certain market conditions make it difficult or impossible to execute such orders. As the chart that covers January 1990 through March 2012 illustrates, drawdowns for managed futures have been less steep than those for major global equity indices. This may be your first time being introduced to managed futures. However, managed futures have been long employed in connection with diversifying institutional portfolios. One such example includes Harvard University. Jack Meyer, the former chief executive of Harvard's endowment fund, which is one of the largest endowments in the world, regularly included commodity and financial futures-related instruments in their portfolio. In fact, this proponent of modern portfolio theory has placed himself on record by stating, "Holding managed futures offers protection against the ups and downs of stocks and bonds. They're the most diversifying asset in the portfolio. The benefits of diversification are indisputable. Diversification rules. It's powerful, and our portfolio is a good deal less risky with commodities than with only the S&P 500. Jack Meyer. Are managed futures riskier than stocks? You may have already asked yourself this question. Futures trading has many risks, and we believe that two important issues that can make futures trading risky are a lack of money management and the unprofessional overuse of leverage. Over-leveraging a futures account can possibly lead to great profit or a very substantial risk of loss. This method of trading is speculative in the extreme and has more in common with high-stakes gambling than the traditional idea of investing. Futures, in general, are riskier than stocks due to the great amount of leverage one can utilize in futures trading and the potential for unlimited risk. We also believe that these two factors can be reduced by utilizing a CTA. As mentioned previously, CTAs are professional money managers who make their living trading the accounts over which they have discretion. Regardless of the markets they are trading, there are money managers that succeed and fail in any market, be it futures or stocks. Keep in mind that there is substantial risk of loss no matter who is managing your money. Thomas Schneeweiss, professor of finance at the University of Massachusetts, in his 2002 academic study, Benefits of Managed Futures, challenges the misconceptions of managed futures as investments that are riskier than stocks. Schneeweiss found that managed futures are not any more risky than traditional equity investments. Investment in a single commodity trading advisor is shown to have risks and returns which are similar to investment in a single equity. Moreover, a portfolio of commodity trading advisors is also shown to have risks and returns which are similar to traditional investments. There was a further comparison in the risks of stocks versus managed futures. Professor Schneeweiss's conclusions are strongly supported in an academic study conducted by Professors Gary Gordon and K. Gert Rowenhorst. The name of the study is Facts and Fantasies About Commodity Trading. Both professors are from some of the top universities in the U.S. Gordon is from the Wharton School of Business and the National Bureau of Economic Research. Rowenhorst is from Yale University's School of Management. The conclusion of the professor's study, Facts and Fantasies About Commodity Trading, states, during the past 45 years, commodity futures have had roughly the same return as stocks with less risk, have way outperformed bonds, and are a better hedge against inflation than either stocks or bonds. Be advised that these studies were conducted in academia and don't necessarily represent actual trading results. To add to the benefits already mentioned about managed futures, you as an investor may take advantage of some tax benefits by investing in managed futures. According to the Tax Act of 1981, short-term profits in futures are treated as 60% long-term, therefore being subject to a maximum tax of 15%, and 40% short-term, normal taxable income. On the other hand, short-term trading profits in stocks held less than 1 year, are treated as 100% short-term. This favorable tax treatment for futures can translate for those in the upper tax brackets into savings as much as 30% on short-term gains in the futures versus stocks. Alternative investments such as managed futures are not suitable for all investors. We recommend that managed futures should only be used with speculative capital. Tax rates are subject to change from time to time as set by federal and state guidelines. We recommend reviewing any tax consideration with a qualified tax professional. If you're like many investors, you like to be able to track your investments at all times. So if you are wondering if you can track the performance of your managed account, the answer is definitely yes. You will always have access to the trading activity in your account 24/7, and there are 3 different ways you can track your account. The first is that you're receiving a complete accounting of all activity in your account, including the account balance, 24 hours a day through Visions and Vision Portal. The second way is that you may call your Optimus Futures advisor, who will receive a daily equity run detailing all your open positions, netting all profits and losses, and showing the exact daily balance in your account. So if you're not familiar with some of the complex option and futures strategies that a CTA might implement, your Optimus Futures advisor, who is a registered representative, will be able to guide you through the positions and tell you what the risk and reward benefits are for each position entered. The third is, regardless of whether you call or not, or access your online account, A purchase and sale statement will automatically be sent to your chosen mailing address or email address on every single trade. The purchase and sale statement shows the date and price entered, and when you exit a trade, the date, price, net profit or loss on the trade, and also your account balance. Furthermore, besides receiving confirmation on every individual trade, a summary of all transactions showing their results are sent each month for the entire month's transactions. Therefore, even if you don't call, you will always be provided with a written, detailed report of the transactions and the performance of your account. Now that you've learned the benefits of managed futures and the power of portfolio diversification using managed futures, what's next? Well, if you're interested in opening a managed futures account, have questions with regards to opening an account, or wish to inquire further about individual CTAs, please contact an Optimus Futures advisor. Our professional staff is standing by to take your call and answer any questions that you may have. You can also email us at support@optimusfutures.com. For more information on any of the topics, studies, or facts mentioned in this presentation, you can go to our website at www.optimusfutures.com. Again, if you'd like any more information regarding managed futures, call us today at 1-800-771-6748 or visit us at www.optimusfutures.com. Please be advised that trading futures and options involves substantial risk of loss and is not suitable for all investors. There are no guarantees of profit, no matter who is managing your money. An investor must read and understand the Commodity Trading Advisor's current disclosure document before investing.